Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So Warren Buffett has just made a new investment and it was close to a $10 billion deal. So I want to get into some of the details of that particular investment. It's something that Buffett hasn't done for quite a few years now, is make a new investment. So first let me get into a little bit of the background with that, then let's dive straight into the details of some of this new deal. So first, some background. So for those who haven't been following Berkshire Hathaway and Warren Buffett particularly closely over the last few years, basically he has been getting a lot more criticism over the last year or two for not having made any large investments recently. Basically, Warren Buffett has been sitting there with his current holdings, having all of his businesses that he wholly owns produce a lot of cash like they always do, have some of his public companies pay dividends, and really just have that cash pile kind of accumulate to massive levels over time. So during his last quarterly report, he reported that he had $137 billion in cash, which is more cash than Berkshire Hathaway's ever had, and it's well over 25% of Berkshire Hathaway's market cap. So a huge percentage of the portfolio in cash, not from necessarily selling any investments, but really from just not buying and having his current investments produce a lot of cash flow, make a whole lot of money, and he's just sitting there with this absolute mountain of cash, ready to go for when the elephant-sized deals do come up. And really, Buffett hasn't made a large acquisition since his initial purchase into Apple, and that was a purchase that was made on the public markets. It was somewhere in the $30 billion range, his total investment in Apple. It bought him a little over 5% of the company, and that particular position is worth something in the $60 billion range now. So over the last sort of 3 or 4 years since he's first started buying into Apple, that investment has performed really, really well. And this new deal with Dominion Energy is really the first major acquisition that he's made since that first Apple investment. So let's get straight into some of the details. I'm going to be reading from a Bloomberg article here, and there's a couple of interesting things about the way this particular deal is structured. And one thing with the company that Buffett is buying some of these assets from that really kind of made me laugh. So let's get straight into that. So I'll leave a link to this article down in the description below. This is coming from the New York Times. I think I just said Bloomberg before, but this is a New York Times article. So the article reads, Berkshire will pay $4 billion for Dominion's gas network assets, including more than 7,700 miles of natural gas storage and transmission pipelines, and about 900 billion cubic feet of gas storage. The Dominion purchase was Mr. Buffett's biggest in 4 years, putting to use some of Berkshire's $137 billion cash pile, and it will probably quell some investor anxiety about Mr. Buffett's recent drought of deal-making. It follows the unexpected death of the Atlantic pipeline. Just last month, Dominion and Duke scored a victory when the Supreme Court ruled that the pipeline, which would have moved natural gas from West Virginia across 600 miles to Virginia and North Carolina, could be built under the Appalachian Trail, overruling objections from environmental groups. The energy companies said that the 6-year-old project faced more potential legal battles and costly delays. The pipeline's cancellation may have also been a bet on Democratic victories in the upcoming US elections. That is almost certainly not true. Just as an aside here, Buffett does not make bets based on what he thinks is going to happen in the next election. He holds companies that are going to do well regardless of who's in power government-wise, so ignore that bit. And announcing the deal with Berkshire, Dominion emphasized a narrowing focus, becoming a more sustainably focused utility, reducing reliance on fossil fuels. Power companies like Dominion are moving toward using more renewable energy sources. So there you have it. That's kind of the high-level view of the deal. Basically, Warren Buffett is putting about $4 billion to work on buying some natural gas pipelines from Dominion Energy. Now, Dominion Energy is a public company, which is worth much more than the $10 billion that he's paying and the $4 billion of cash that he's putting to work. I'll put up, again, a screenshot of their stock and of their market cap here so that you can see that. And there's a couple of interesting things about how this deal is structured. So the first thing is that Warren Buffett is actually going to take on some debt to do this deal. And it was kind of surprising to me that in his recent annual meeting, he actually mentioned that Berkshire Hathaway had borrowed some money. And typically when companies get into distress situations through crises like we've had over the last few months, Buffett is usually the first one there to lend people money when it gets to attractive interest rates, because these businesses are in distress. So for Buffett to actually go out and be on the other side of that deal and borrow money, it's not a suggestion that he's in distress by any means, because Berkshire is an absolute fortress. But it just goes to show that interest rates are extremely low, and Buffett finds, borrowing money to be a very attractive proposition at the moment. So as part of this deal, you'll see a couple of different numbers. So the first thing is you'll see that Buffett put $4 billion of his $137 billion to work in this particular deal. He's also taking on about $6 billion of debt that he is basically taking off Dominion Energy's hands. So this is one of the advantages of why I like to use sort of like an enterprise value metric. This is basically what Buffett has done here. Although he's paid sort of essentially a $4 billion purchase price on the deal, he's basically paid $10 billion because he's also taken on $6 billion of debt. So he's paid sort of a $10 billion enterprise value, and that's, in my opinion, at least the best way to kind of think about these types of acquisition. Now, this particular business is going to fit really nicely into Berkshire Hathaway Energy. So Berkshire Hathaway Energy is a massive subsidiary of Berkshire Hathaway. It's a huge component of their business, and it's run by a guy by the name of Greg Abel. I'll put up a photo of Greg Abel here. And Greg Abel, you might actually recognize from the most recent Berkshire Hathaway shareholder meeting. So he was the guy that was sitting next to Warren Buffett, answering questions because Charlie Munger couldn't make it. The risk just wasn't worth it with the illness going around at the time. And Greg Abel has been in the position of running Berkshire Hathaway Energy for a long period of time now. And like was mentioned briefly in this article, Berkshire have been doing a lot of work to move towards more sustainable energy sources. So they're getting away from more traditional ways of producing electricity, things like burning coal, for example, to more sustainable energy sources such as wind and solar, especially wind in the case of Berkshire Hathaway. So there has been a lot of money invested by the parent company Berkshire to down towards its subsidiaries to go through that transition. And it's been really profitable. It's an interesting business because for a lot of those electricity and utility companies, basically the rates in terms of return on capital and so on are not attractive for private investors to go down that track. So it is government regulated, and Berkshire are allowed to actually make a reasonable return through that investment. So there is some government support actually in helping those particular investments get off the ground. So it does not surprise me whatsoever that Berkshire is continuing to invest in the energy space. This is a very large deal, but relative to the overall scope of Berkshire's cash pile, it's going to drop them from $137 billion down to $133 billion in cash. Plus, they're probably going to produce more than $4 billion in cash flow this quarter, I would have thought. So that cash will more than replenish itself, I would say, before the next public filings and so on come out. So interesting deal, relatively big deal on the surface of things, but Berkshire is just an absolute Goliath at this point. So it is really not going to make a huge dent on the future returns for shareholders moving forward. Now, there's just one final thing I wanted to finish on, which I found kind of funny, and this was a press release that actually came out of the parent company Dominion. So the CEO basically came out and said, we have been selling off some of our assets in order to reduce our debt load and increase our equity position. And that makes a whole lot of sense. A lot of companies that sometimes get themselves into trouble do take on this approach of sort of downsizing, paying off their debts. A really good example of that happening in New Zealand actually at the moment is Fonterra. They've been selling off some of their subsidiaries. They've been selling off some of the shares they own in some public companies and so on as well, to try and reduce their overall debt load, get some more cash into the business, and just reduce the risk of potentially massive downside for shareholders. So interesting that Dominion are taking a similar approach. What absolutely cracked me up is that basically on the next the next sentence almost of that press release, they said, this is great. We're going to take on this cash and reduce some debt. And then in the very next sentence, they basically said, we expect the majority of this cash to be used for share buybacks. And that basically means that, they're taking all this cash from selling off their assets. They were expecting to move some towards debt. Potentially, Buffett, fortunately, has taken some of that debt away. But instead of putting that cash towards paying down even more debt, they're going to go out and buy back the shares, basically get rid of all that cash, keep their debt just as it was, and kind of carry on with life. So I thought that was kind of funny. It just shows, some of the thinking in terms of capital allocation and so on that goes on some of these public companies. I don't know the case with this particular business, whether they have some sort of compensation plan that's tied to earnings per share or something which would incentivize share buybacks. I just don't know. But that seems like a really silly, stupid, just crazy move to me. So I thought I'd finish on that. I found that kind of funny. But nonetheless, it's great to see Warren Buffett making acquisitions. Berkshire Hathaway shareholders, I'm sure, will be very, very happy. Although cash can turn you into an absolute financial fortress, at the end of the day, cash does not make particularly high returns over the long term. So it is cool to see Buffett starting to put at least some of that to work. And I hope there's massive market volatility and he can do a whole lot more. So hope you enjoyed the video. If you did, please hit like and hit subscribe. You can watch some older videos over there. Hit subscribe over there, and I will see you in the next one. Cheers.